Okay, welcome to another CE on a Friday morning, a beautiful Friday morning. Um, and we are happy to be learning about disability insurance. Um, I'm hoping that not only do you enjoy the CE, but perhaps you see opportunities to cross-sell and to help other people with disability. And so we have John here who helps us on a regular basis with these. He's part of Mountain CE, as you can see here. And so, John, you want people just to interrupt you if they have questions, or do you want them to put their questions into the chat feature, or what's your preference?
It'd probably be best to put them in the chat feature, and I'll pause every once in a while and see if anybody has any questions or comments to make.
You'll probably get a little notification that pops up when they do put something in there. So,
all right. Would you like me to monitor that, or is somebody?
I'm sure that both Nancy and I will be monitoring it, and if we don't need you, we'll answer, and if we need you and you haven't answered, then we'll sort of, Nancy's pretty good at jumping in and saying stuff. So
awesome.
So John, take it away.
All right. Thanks, Doug. Thanks, Nancy. And welcome, everybody. My name is John Maurer. I'm with Mountain CE. I'm one of the owners of the company. My business partner and wife of many years, Marlene, is the other owner of the company. So we've been doing this for 21 years now. We help people with their CE, and we also do exam prep for those who are studying for their insurance license. So the name of this course this morning is Disability Insurance. It's a webinar, and it counts for your classroom requirements. So remember, in Utah, you have to have 24 credits, of course, and at least 12 of the 24 have to be considered either classroom or classroom equivalent. So if you, for example, do AHIP, the AHIP training, you can get 6 credits per year, but that's considered self-study, and it doesn't meet the classroom requirement. But this one does, and it's going to be 2 credits for Utah resident producers. We're starting now at 10 o'clock going until 12. We'll have a halftime break, about a 10-minute break, about halfway through, somewhere around 11 o'clock or so. We'll take our break. All right, so I want to ask you all a question about disability, and the question is, do you think it's, and I think you probably already know the correct answer to this question. Oops, something just popped up here. But the question would be, is a person more likely to die during their working years or more likely to become disabled during their working years? So you can answer that in the meeting chat. Go and locate that. And I'm sure you already know the answer. You probably heard the answer before. And of course, yeah, a person is much more likely, actually, to become disabled during their working years than dying during their working years. And so that really helps emphasize the importance of disability insurance. And I think, in my opinion, disability insurance is one of those things that doesn't get a lot of publicity or doesn't get a lot of thought to it. Everybody knows that most people understand the importance of having life insurance, especially during their working years, but disability insurance sometimes doesn't get the proper attention that it needs. So, and also, just before we keep going, if you ever have any questions about insurance licensing, well, whether it's renewing your license or adding another line of authority to your license, or having somebody new that you're associated with, a friend, a relative, or somebody that's going to be working with you in this industry, needs to get licensed, give us a call. We can answer all the questions about that. All right, so here's a question, and remember, at the end of the session, you're going to be asked 3 polling questions, we call them, and you have to answer them. You have to get them right to be able to get the C credit. So you never know which questions are going to be part of those polling questions. So here's a question for you to consider. And I want you to, if you're not sure the answer, just take a guess. For an insured worker who attained age 20 in 2025, the probability of becoming disabled between age 20 and normal retirement age, which is now 67, is what percent? So if you're not sure, just give it a guess. And so to get the C credit, you don't have to get it right now, but you might have to get it right later. So this is an important question. All right, so a lot of you going through the answers are, it's kind of all over the board. Yeah, some of you are saying 24%, some are saying 8%, some are saying 12%. But the right answer is 24%. That's a significant number, wouldn't you say? So about 1 in 4 workers who are young workers right now, there's about a 1 in 4 chance that they'll become disabled. And so how are we defining disabled? Disabled means unable to work and unable to earn income. That's the definition of a disabled worker. So I really want you to appreciate the fact that it's a pretty significant chance of becoming disabled throughout a person's working years, at least for a significant period of time. All right, any comments or questions there? We're going to shift gears a little bit now and go into some important things about disability insurance.
Yeah, Gina raised her hand. Gina, you want to just ask your question?
So the question, maybe there was a question, I don't know if this is the same question, but temporary or permanent, yeah. So it could be a temporary disability, it could be a permanent disability, either one.
Good question.
Yep, thank you. Any other questions or comments so far? All right.
Gina raised her hand, but I'm not sure if her mic's not working or. Jenny, you could put your question in the chat feature if you're interested. I'd say let's just go ahead. She'll figure
Okay.
out.
Very good.
Bob asked, can you qualify this number? I guess that's the 24%, Bob. I'm not sure what.
Okay, so where did that come from is the question. So that came from the Social Security, the U.S. Social Security Department or whatever it gets called. It comes from the U.S. government statistics from Social Security.
Bureau of Labor Statistics, probably.
Yep. All right, I'm going to now share a different screen, and we're going to get into some details about disability insurance. Oh, I just got to find the right button. One moment.
While you're looking, one question is the disability more due to injury or due to illness? You know?
I don't have that number right off the top of my head, or which one is more. My gut instinct tells me it's more typically due to illness, but I can get a better answer for you on that. That's just my gut instinct.
So Sid said that he found he said he found it, the 24%, I guess, on the workers' comp stats. So.
Okay. Very good. All right. Let me push the right button. I just got to find it.
Can you hear me?
Do you have a question?
answer the question. I couldn't answer the question for the 24%. How do I physically do that on my computer?
Oh, it's there's a chat feature on the Google Meet where you can put in the answer.
Okay, well, where is that?
It's down in the lower right-hand corner of your browser. It looks like a conversation bubble in comic strips, if you see that.
No.
Does anybody else have a better way of explaining this than I do?
Are you on your phone, Gina, or are you on your computer?
I'm on my computer.
Okay.
It's next to the waffle, isn't it? Next to the waffle with the little text box.
That's where mine is. It's right. It's just to the left of the waffle on my browser.
Yeah.
Okay. All right.
That was great, Colette. Thank you.
Yeah, the waffle with the 9 dots.
Next to it.
Yep, just to the left of it. All right, so first thing we're going to talk about with disability insurance is qualifying for benefits. And I'll make this bigger so we can see it better. And this is something we just talked about just a moment ago. Sometimes disability insurance is overlooked however, it's a very important insurance product. Disability of a person can result in serious financial hardship to a person's family, often more serious than death, right? Because if I die, well, I know I'm no longer going to have to eat. I'm no longer going to have to be cared for, right? But if I become disabled and now I still got to eat, so people have to take care of me, that costs money. And so that could be much more of a financial burden than if I were to die, perhaps. Depends, of course, on the situation. So when it comes to disability insurance and whether or not a disability insurance policy will pay a claim or not, there's got to be some kind of a measuring stick, a way to measure disability, and there's 2 different ways to measure it. In other words, 2 different ways to define a total disability. One is called own occupation, sometimes referred to as regular occupation. This definition of total disability means that the insured will receive a benefit if he or she is unable to perform the duties of his or her own regular occupation. So this is an interesting thing, because I remember a number of years ago, we had a neighbor in our, not too far down from our house, and in conversation, didn't know this person really well, but in conversation, like he had said that he was disabled, he was on disability, he was getting a disability income, but it seemed kind of odd to me that he was going out and doing all kinds of interesting things like mountain biking and so forth. And I thought to myself, well, that doesn't really make much sense. This person is a scam artist, maybe, because he's on disability, but yet he can go and ride a mountain bike. That doesn't make sense to me. Well, then it occurred to me, well, and in further conversation, he was formerly an airplane pilot. All right, so that was his occupation, airplane pilot, and it made sense because he had a medical condition that wouldn't allow him to fly airplanes anymore. He could ride a mountain bike, that's fine, but then it made sense, right? Because he's getting a disability income from a disability income policy. Yeah, he can ride a mountain bike, but I wanted him to fly the airplane that I was riding in. And then the other way to define total disability is called any occupation. This means that the definition of total disability means that the insured will receive a benefit only if he or she is unable to perform the duties of any occupation for which the insured is reasonably qualified based on education or experience. So that's a really important thing to consider when you're looking at a disability income policy, when you're selling one or buying one. Is it going to pay based upon the inability to do one's regular own occupation or any occupation? And then the question becomes, which one is it easier to qualify for benefits? So if you want to turn your microphone on and say it, you can, or if you want to put it in the chat, which one is it easier to qualify for benefits? Own occupation or any occupation? All right, looking at your answers. Yeah, of course. It's easier to qualify if the policy says own occupation, which means your regular occupation, it's going to be easier to qualify. So another way of saying it is if a policy has an own regular occupation definition, it's less restrictive. It's easier for the insured to qualify for benefits, since the insured will receive a benefit merely by the inability to do that particular occupation. So when it comes to like surgeons, airplane pilots, and what might be some other occupations that are highly skilled, that would probably have an own regular occupation definition. Roofers, okay. A diesel mechanic, okay. You think of some other ones? A bricklayer, perhaps. A dentist, yeah. Yeah, any kind of a physician, a marine welder. All right. All right, so in comparison, if a policy has an any occupation definition, it's more restrictive. It's more difficult to qualify for benefits, because if I have a disability policy and it says it'll pay a benefit if it's under any occupation definition, then I have to be in pretty rough shape. All right, so I might not be able to walk, but I can still sell insurance, perhaps. So policies that pay a benefit under the own regular occupation definition typically do so for only 1 or 2 years, right? So I'm a surgeon. I now have a disease that doesn't allow me to become a surgeon anymore, I get paid a disability benefit, but it's probably only going to last a year or two. And then after that, then I'm only going to be able to get a disability income if I'm unable to do any occupation. You know, different policies have different rules for that. And simplifying things, it can be kind of complicated how the definition is, but this kind of gives you a good basis. All right, any comments or questions that you can think of so far? So important to know the difference between own, which means regular occupation, and any occupation.
John, I have a question. How is that different from Social Security disability?
Yeah, so it's my understanding that disability income insurance, or under Social Security, is any occupation. So in other words, in order for Social Security to pay a disability benefit to a worker that's become disabled, it's very difficult. It's because it follows more towards the any occupation. So if I'm a surgeon and I have some type of disease, I can no longer be a surgeon, but I can sell insurance. Social Security will not pay me a benefit. All right, did that answer that question?
Yes, it does. Thank you.
Thank you. Any others right now? Okay, I'm sorry, go ahead.
I just wrote in the chat, is that benefit payment limitation depending on group versus individual? Does that change depending on the policy, or is it typically always around 1 to 2 years?
Yeah, there's just so many different companies and policies out there. So just something to be aware of. I don't have any statistics that, this many policies are this or this many policies are that. But quite often it's just going to be especially under individual policies, it's going to be 1 to 2 years. But it doesn't have to be.
So
Right.
there, Laura says, is there an underwriter who makes the final determination, say if it's in a gray area?
You mean a claims adjuster?
I assume a claim
Yeah.
adjuster being a type of underwriter. Yeah.
Yeah, so a claims adjuster, is going to make a decision, of course, and a claims adjuster is going to rely on documentation from the physician that has seen the worker who has become disabled to determine, what benefits would be paid.
So Tim says, he says cannot do both Social Security disability and personal policy ? So I guess he's saying if your personal disability policy pays, does that disqualify you from Social Security disability? I guess is the question. Tim, you'll have to clarify.
Yeah, I think the short answer there is there's going to be a coordination of benefits. So an individual policy might pay less if a person qualifies for Social Security disability.
So Sid Haycock says, yes, you can collect both.
Yeah, I think you can collect both, but the individual policy or the group or individual policy may pay less because of what Social Security pays. But yeah, you can get benefits from both.
Okay.
All right. So the benefit paid by disability income can be triggered 2 different ways. So one is called an indemnity policy. So of course, the word indemnity in the insurance language means to reimburse somebody for something. So indemnity policy is going to reimburse a specified dollar amount. It could be per day, it could be per week, it could be per month. If the insured is unable to work due to injury or illness, this type of policy becoming disabled will trigger a benefit to be paid. This type of policy will pay a benefit only if the insured is unable to work after the injury or illness occurs. So that's kind of the old-fashioned way of doing it, like either a person can work or that person cannot work. That's how it looks at it, but a more sophisticated, better way to look at it and more recent, more modern way of looking at it is called pure loss of income, also called income replacement contract. It'll pay if the insured suffers a loss of income. For this type of policy, the loss of income due to injury or illness will trigger the benefit to be paid. And it's important to realize that this type of policy will pay a benefit even if the insured is still able to work full time after injury or illness occurs, but is not as productive as he or she was before the injury or illness happened. So, for example, suppose I'm a salesperson. I have a sales job and I drive around all over the place making sales calls, and I work 70 hours a week. I'm constantly visiting customers, and I make a good amount of income. But I have some type of disability. I can still do the job. I could still maybe work full time. I could work 40 hours a week, but I'm going to be sitting at my desk making calls instead of driving around meeting customers face to face. And maybe because of my disability, I can't work 70 hours a week, but I can do 40 hours a week. But now my income is half of what it used to be because of my disability. So with pure loss of income, also called income replacement contract, it's going to pay even though I can still work full time, but I'm earning less because of my disability. All right. Next topic is the concept of presumptive disability. So it has the word presume. And sometimes the word presume has a negative connotation, but not so much here in this context. Presumptive disability is a condition that automatically qualifies insured for total disability benefits, regardless of whether he or she can work. So if a person has a disability policy, there's going to be probably some kind of a clause in there, a rule in the policy that says if I have a certain condition, like I lose 2 or more of my limbs, or I have a leg that's amputated at the hip, or I lose my eyesight, I lose the ability to speak, I cannot hear, I can't get around, I'm paralyzed, or I have a terminal illness. Those are examples of presumptive disability that are going to automatically qualify me for disability benefits, even though I might still be able to work after one of these things happens to me. So once it's determined that the insured has a presumptive disability, normally he or she does not need to undergo continuous medical exams to prove that he or she has a disability. Presumptive disability is often a standard feature on disability income policies, but the policies might vary based upon what qualifies as a presumptive disability. Next concept is the concept of physician care requirement. So income policies that pay the benefit if the insured becomes disabled. And therefore, it's important for these policies to clearly define disability. And many policies will say that the insured has to be under the care of a physician, a doctor, for benefits to be paid. Many policies will only pay if the insured has a total disability. Some will pay if there's a partial disability. All right, any questions before we go through some quiz questions? All right, and so go ahead and answer in the chat. So again, that's the little icon to the left of the waffle or the 9 dots in your toolbar. And you can answer either A, B, C, or D if you like in the meeting chat. So why is disability income insurance very important? Let's see if you can find the right answer and put it into the chat. And this question is so easy that even I could get this one right. All right, of course, the answer is going to be D as in David. The disability of a person can result in serious financial hardship to the person's family, sometimes more serious financial hardship than even the death of the person. All right, very good. Question number 2, for benefits to be paid, many disability policies will only pay if what? A, B, C, or D? All right, so a lot of you are answering either B as in brother or D as in David. And the best answer is going to be B as in brother, under the care of physician. All right, and some of you answered D as in David, but so let's talk about that. The insured is permanently disabled. He said that some policies will only pay, or many policies will pay only if the insured is totally disabled. But that's not the same thing as permanently disabled. Permanently means forever, and total means can't work at all, either for a short time or a long time. And so D as in David is not the best answer here. because policies will often pay even if it's a temporary disability. Okay, here's the third one. Which of the following statements is false about pure loss of income policy? So here's a test taking tip if you ever need to take an insurance exam in the future. When you get a question like this, which one's false, it's easiest to tackle it by looking for the three things that are true. So let's go through it together. Number one, it pays a specified amount if the insured suffers a loss of income. That's true. Number two, loss of income due to injury or illness will trigger a benefit to be paid. That's true. It will pay a benefit even if the insured is able to work full-time. That's true. If I suffer a loss of income, even though I can still work some or a lot, it'll pay a benefit if it's a pure loss of income policy. And so the first three statements are true. The last one is the false one. Number four, which following is a condition that automatically qualifies the insured for total disability benefits, regardless of whether he or she can work? A, B, C, or D? Yep, it's going to be presumptive. In other words, if I have a certain condition, like I can't see anymore, I can't talk anymore, I can't hear anymore, it might be presumed in the policy that I'm going to qualify for benefits, regardless of whether I can really work or not. All right, awesome, good job. Let's move on to the next lesson, talking about we're going to talk about individual disability income, and then later we'll talk about group disability. So individuals may choose to purchase individual disability income insurance if their employer does not offer disability insurance or if they're self-employed. Premiums are paid by individuals with after-tax dollars. So that means that the premiums are not tax deductible, and therefore the benefits received are not taxable either, though. All right. So we gotta remember that. It's kind of like, when I pay my life insurance premium, when I pay my auto insurance premium, my homeowner's insurance premium, I don't get a tax deduction for that. And neither if I have an individual disability income policy, I don't get a tax deduction. But the good news is that when I become disabled and get benefits, the benefits received are not taxable. So basic disability plan protects families against financial hardship if the insured becomes unable to work due to an injury or illness. These plans vary in specifics such as income benefits. It's how much is what's going to be the amount paid by the plan per month while the insured is disabled. Then another one is how long is the benefit period? The number of monthly benefits that will be received, or the age that monthly benefits will stop being received. And the plan can vary by whether or not it has a waiver of premium rider. So with this feature, it's an extra benefit for an extra charge, an extra feature for an extra charge. It's going to allow me to stop paying the premiums. So not only if I become disabled, not only will it pay me a benefit, but also I won't have to pay the premiums while I'm disabled. All right, and then there's also going to be a probationary period and elimination period. We'll talk about that in a moment. So the probationary period is of a disability income policy is a period of time. It might be 30 days following the date of issuance, also known as the effective date of policy, before the coverage begins. So the whole purpose of probationary period is to prevent adverse selection. So adverse selection, of course, is an insurance term. That means that we're trying to prevent situations where people are buying the insurance right when they know they need it. It's kind of like, if I don't have insurance on my house and my house catches on fire, I call up an insurance agent and say, hey, I need insurance on my house. Kind of the same thing here is like I'm working and I don't have disability insurance and I don't feel good and I'm pretty sure something's really bad. Something really is going bad with me. I have some kind of bad illness. So I go ahead and buy disability insurance real quick. So that's why there's this probationary period. That means it's not going to pay a benefit if I become disabled within that certain amount of time, typically 30 days. All right, another important term we need to understand is the elimination period. That's not the same thing as a probationary period. Elimination period is a waiting period, and it could be 30 days, it could be 6 days or 90 days that the insured must wait after he or she has become disabled before becoming eligible for benefits. So the easiest way to look at what an elimination period is to kind of think of it as a deductible. Deductible on health insurance or auto insurance, home insurance. But here, elimination period is kind of like a deductible, but it's not measured in dollars, it's measured in days. So the longer the elimination period, the lower the premium, of course, on a disability income policy. And if a policy, and most policies do have elimination period, if it's 60 days, then the benefits are going to start on the 91st day that I'm disabled. All right, so 2 months, 60 days has to pass. Okay, then on the 61st day, I'm eligible for benefits, but I'm not going to get a benefit right then. I'm going to have to wait another 30 days to actually receive the benefit, because benefits for disability income payments are made, what we say, in arrears after the fact. After the month that I'm disabled, that I qualify, then I get the benefit. All right, any questions on probationary period, elimination period? So we touched upon this a moment ago. Loss of income due to disability can also be covered by Social Security. It can be covered by workers' compensation insurance. So there's important things to consider is that not all people with disabilities qualify for Social Security disability. Remember, that question came up at the beginning of class, and a majority of people that apply for Social Security disability benefits are denied coverage. That's because Social Security uses a very strict definition of total disability. A person has to be unable to do any occupation to qualify for Social Security disability benefits. And Social Security has a 5-month waiting period. That's a 5-month elimination period we talked about for disability benefits. So therefore, the individual must be considered totally disabled for 5 months before benefits begin. And since payments are made in arrears, the individual would receive the first payment at the end of the 6th full month of total disability. So the amount of benefits provided by Social Security and work comp might not be enough to pay the living expenses of the person with the disability. And recognizing that Social Security and work comp cover disabilities, but that these programs have significant limitations and gaps in coverage, insurers offer riders to disability income policies that pay benefits according to what these programs pay or do not pay. So there's a coordination of benefits. And if I do have a disability income policy, an individual policy, it's going to fill in the gaps, so to speak, that Social Security has. And work comp, of course, will only pay if the disability was caused by injury or illness related specifically to the work. So there's different names for these types of riders that coordinate the benefits with Social Security and disability. They can be called additional monthly benefit, A&B rider, Social Security rider, Social Security offset rider, social insurance supplement rider are some names for them. I think I saw some comments in the chat. but they disappeared now.
So Sid says Social Security applies generally to the long term. SSD generally has a 24-month waiting period. So just
Okay.
I guess addition to what you're saying or something.
All right. Yeah. Yeah, we'll talk more about that a little bit later, about the 24 months. Okay, next is we have to, of course, look at occupational versus non-occupational. So an occupational disability is due to injuries or illness that happen during work or because of working a job. It could also include illness. A non-occupational disability is due to other injuries or illnesses. So most disability income insurance policies cover non-occupational disabilities. Some may cover occupational disabilities. But so in order for work comp, for example, to pay, it has to be an occupational disability. And the benefits, any benefits provided for occupational disabilities are normally reduced by the amounts of benefits provided by work comp and or Social Security. We need to be aware of a permanent disability benefit. So permanent disability is a disability that's expected to last for the remainder of the insured's life. And there's two different kinds of permanent disability. There's permanent total, of course, which means the insured will never be able to work again. Benefits are based on the entire amount of the lost income. But permanent partial means that the insured can still work, but the disability results in a reduction of income, and benefits are based on the amount of reduced income. All right, here we go with a couple of questions. And it's taking a bit. There we go. Which rider allows the policy to stop paying the monthly premium if the insured becomes disabled? Okay. All right, it's going to be waiver premium rider, of course. And on life insurance policies, of course, there's also a similar waiver premium rider that can be available. Which statement is false? Let's do this together. We're looking for three things that are true. Permanent partial disability means the insured can still work, but the disability results in a reduction of income. Benefits are based on the amount of reduced income. That's true. A permanent disability is expected to last for the rest of the insured's life. Of course, that's true. The two types of permanent disability are basic and probationary. That's false. Because the two types are permanent and temporary. I'm sorry, total or partial, I should say, sorry. And then the last one is true. Permanent disability means the insured will never be able to work again. Benefits are based on the entire amount of lost income. Number 3, which of the following statements about basic total disability plan can be purchased by an individual? Let's do it together. If you know the answer, you can put it in the chat. Number A, the benefits received are not taxable. So that's going to be true. Because benefits received under an individual policy are not taxable benefits, same as like life insurance benefits, not taxable. So number 1 is true. Number 2, premiums are tax deductible and benefits received are taxable. That's going to be false. Number 3 is true. Premiums are paid by individuals with after-tax dollars, which means you don't get a tax deduction. And number 4 is true. It protects families against financial hardship if the insured becomes unable to work due to an injury or illness. That's true. Second one is false. That's the right answer. All right, number 4, under a basic total disability plan, the amount paid by the plan per month while the insured is disabled is called what? Amount paid by the plan. All right, lots and lots of right answers. Of course, it's called income benefits, the monthly indemnity, the amount of reimbursement. Awesome. Let's go to the next lesson. So policies can provide what we call at-work benefits. So while a person is working but has a reduction of income because of a disability, the benefits received there are considered to be at-work benefits. And there's 2 different types of at-work benefits. There's partial disability and residual disability. Let's talk about the difference. Oops. I pushed the wrong button. There we go. So if an insured has a partial disability, it means the insured is able to perform some of the duties of his or her occupation, but not able to perform all the duties of his or her occupation. And it's like, so there's kind of like with the concept of the feature of partial disability, either insured has no disability at all, or the insured has a complete disability, can't work at all, or somewhere or halfway in between, so to speak. So that's not a really sophisticated way of doing it. So a better way of doing it, a more recent way of doing it, is called residual disability. And of course, the word residual means the amount that's left over, the residue, so to speak. And with residual disability, if the policyholder is permanently and partially disabled, but able to return to work, the residual disability benefit will continue to pay the insured a portion of the disability benefit each month, typically until the insured reaches age 65 or until the policy's maximum benefit has been reached, depending upon the policy. So I was making $2,000 a week, and now because of my disability, I'm only making $1,200 a week. So my benefit is going to be based upon the $800 of income that I've not able to obtain. All right, so here's an example of that. So in this example, this guy has a disability income policy, pays $2,000 a month. He made $5,000 per month before the disability. His income has decreased to $4,000 per month because of the disability. So therefore, it's going to be, he's losing $1,000 a month because of the disability, and therefore he's going to get 20% of the $2,000 amount of a disability per month. So it'd be 20% of $2,400 a month. There's some optional riders that are available under disability cost of living adjustment. That's pretty easy to understand, COLA. But then there's also future increase option, also known as guaranteed insurability. And we see this rider available on life insurance as well. This gives the policy owner the option of increasing the policy benefit at specific future dates or at life-changing events. So there's the insured becomes married, has a child, adopts a child. There's some type of a life-changing event that would allow the policy owner to increase the policy benefits to pay out future policy benefits. And so the nice thing about the future increase option, the guaranteed insurability, is that it will be available regardless of whether the insured is insurable at that point in time or not. So even if I'm sick, every so often, maybe every 3 years, I have this option, a window of time to increase the benefit, or at life-changing events, even if I'm sick at the time. And waiver premium, we already talked about that one. It allows the policy to waive, to not require the insured to pay premiums if the insured becomes disabled. There's an accidental death and dismemberment rider, AD&D. It's available. In other words, it'll pay a certain amount if the insured becomes disabled because of a disability, an accident, I should say. So it's only going to be triggered by an accident. So I guess it's, and this one, accidental death or dismemberment, it means it's going to pay if the insured dies under a disability policy or becomes dismembered. And how do we define dismemberment? It's loss of a certain number of limbs, typically 2 or more limbs, or loss of eyesight, for example, is going to trigger this benefit, this additional benefit under a disability policy. So the principal sum is going to pay the full amount. Like, let's say it's $100,000 is the amount, the face amount on this rider. It'll pay the full amount, $100,000, if the insured suffers death or dismemberment. It'll pay 50%, which is known as the capital sum, if there's a less severe dismemberment, like loss of one eye, loss of one hand, one foot. Rehabilitation benefit rider allows the policy to pay for rehabilitation, as the name suggests. So the purpose of this rider is to pay for therapy and other rehabilitation expenses so the insured can get back to work. Non-disabling injury rider, it's kind of like having a little bit of regular health insurance, medical reimbursement benefit built into a disability insurance policy. So this would be for maybe individuals who have a disability insurance policy but don't have regular health insurance to pay for doctor visits and hospital stays. So it can pay some medical bills if this rider has been added to the policy. And some disability policies have a refund provision. In other words, if the insured hasn't become disabled or hasn't had many benefits paid out under a disability policy, after a certain number of years, like maybe 10 years, some, not all, but some of the premium paid in can be reimbursed back to the policy owner. All right, let's do a couple quiz questions. Question number 1, what are the 2 types of at-work benefits that can be provided in a disability income policy? Okay. Yeah, some of you are answering number 1 or A, individual and group. That's, give you a hint, that's not right. More specifically, it's going to be C, partial disability and residual disability. Remember, residual disability is the better way of doing it. It means that it's going to be based upon the amount of income lost due to the disability. Number 2, which disability income rider increases the policy benefits each year to account for inflation and cost of living increases? Easy one. It's going to be the COLA. COLA. I think there was a song like that, wasn't there? COLA, COLA. Don't make me sing. It's not going to be a good thing. Number 3. Ooh, here's a long one. All these statements about refund provision under disability income policy are true, except which one? There's 3 things that are true. Let's do it together. All disability income policies automatically come with this refund provision. Well, that's easy. That one's going to be false right there. Because it's not very many policies have that feature. It's going to be an extra charge, of course, to have that feature. And regarding accidental death and dismemberment rider, the full policy limit that will be paid in the event of death is known as the what? What's the full amount called? So I'll give you a hint. It's either going to be B or C. B is in brother or C is in Charlie. And most of you are correctly identifying it as C, the principal sum. So here's a tip on how to remember that, kind of a crazy way of remembering that, is that you can think of like a school where you got a principal. The principal, wears the crown. The principal is the ruler of the school, and so the principal wears the full crown, and the full amount is the principal sum. And the students will wear, maybe they can't wear caps anymore in school, but the students only can wear caps. They don't wear the crown. So, and capital sum is the lesser amount. And another way to think of that is the capital sum, like 50%. If there's a lesser injury, the amount is capped at the lower amount. All right, welcome back.
Good to be back.
So I wanted to share where I got the statistic from at the beginning of class. I'm going to push the button here. You should be able to see it. Well, let's see.
Disability statistics, we're seeing it.
That's not the one I wanted to show you. Let me try this again. All right. All right, there it is. I'll make it bigger. So this is from the Social Security Administration. And it's relatively recent, just a few months ago. And is that big enough to see? So for an insured worker, I'm sorry, go ahead.
I'm saying I can see stuff.
Okay, so for an insured worker who attains age 20 in 2025, the probability to become disabled between 20 and normal retirement age, which I think they're defining as 67, is 24%. And the probability of dying between age 20 and normal retirement age is only 13%. And the probability of becoming disabled is about the same for men and women, with both at 24%. However, the probability of dying was significantly higher for men, 16%, compared to only 10% for women. So that's where I got that from. And then I wanted to show you this as well, because this is going to answer another question that came up. It takes me a moment to get there. It should be popping up. Well, there it is.
John, there are a couple of questions here.
Okay.
Lorna says, I'm curious, a few of those questions have 2 answers that could be right, but only show one of them being correct. Is there going to be any leeway for those questions? And by the way, that probably was asked right before the break.
Yeah, so I'm not aware of any errors in the questions about more than one right answer. So if you have a specific example on that, let me know. So as far as these questions that we ask in class, you're not going to be graded on any of these answers that you provide in class here. So you will be 3 questions at the end of class based upon stuff that we learned during class, but you won't be graded on the right answers or wrong answers that you provide in class here.
Bob asked, at what age does disability income stop?
So different policies have different lengths of time, but so there's short-term disability policies that typically pay for like 6 months or a year. And then there's long-term disability, which can typically pay up until the retirement age of like around 65 or so. So it depends upon whether it's long-term or short-term disability, and depends upon what's defined in the policy as far as how long the policy will pay a benefit. But so policies can vary, but some policies, the permanent disability, or I'm sorry, it's called long-term disability, can typically pay until about 65, around 65. All right, so here's some interesting things, and I'm going to give full credit to where this is coming from. It's the Council for Disability Income Awareness, and the website is thecdia.org. And so I'll just summarize, and we can read some bullet points here. But the summary of this is that disability is an important thing to think about. And it says here that at least 51 million working adults in the United States don't have disability insurance other than their coverage through Social Security. Nearly 4 out of 10 adults indicate they can't pay an unexpected $400 bill without having to carry a balance on their credit card or borrow money from somewhere. And one of the questions that was asked earlier is there a higher chance of becoming disabled due to injury or illness? And my gut instinct told me that it was illness, and that's correct. It says the most common reasons for short-term disability claims are pregnancies, musculoskeletal disorders like back problems, spine problems, knees, hips, shoulders, and other parts of the body. So 22% for the pregnancies, and then the disorders of the body that we just talked about, 17%. And then there's injuries, 11%, mental health issues, 10%, digestive orders and hernias and gastritis, 7%. The most common reasons for long-term disability is those musculoskeletal disorders like knee problems, back problems, cancer,
Oh,
and then
Doug,
injuries.
Can you
Go
hear
ahead.
him?
Are you able to hear me all?
Yeah, I can hear you.
Okay, so sounds like Nancy can't hear me.
Okay, now I can.
Excuse me.
Yeah, I'm glad it just kept going. That's good.
All right, so don't want to spend too much time on statistics, but this website, Council for Disability Income Awareness, says that a lot of workers don't have disability that should have disability income insurance, and it's typically mainly due to more related to illness and problems like knee problems, back problems, and things like that. All right, let's get back to where we were. Was there any other questions that have been unanswered so far? All right. So I'm going to pop up this question. because you never know which questions you're going to get for those 3 polling questions after you're in the class. So I want to bring this one up. So which of the following is the length of time, like 30, 60, 90, that the insured must wait? One moment. All right, sorry about the delay there. Still getting over a cold. So what's the length of time, kind of like a waiting period, that a person has to wait before becoming eligible for benefits under the policy? A for presumptive disability, B for probationary period, and C elimination period. All right, so if you answered A, that's not right. It's going to be B. Oops. That is, I think I got the wrong one there. I'm going to fix that right now. I thought I checked these over before class. All right, let's try that again. So it's called the elimination period. So I have to, even though I have the policy in effect, and maybe I've had the policy for months or years, I have to wait after becoming disabled before the policy started being a benefit. And that's called elimination period. It's kind of like a deductible, but it's not measured in dollars, it's measured in days. All right, so that's an important question to remember, the answer to that one. All right, let's get back to our lesson. And we'll continue on. I'm going to switch gears. And that should come up now. We're talking about now more details about individual disability underwriting. We have to consider the occupation of an individual. So occupation is a very important factor, underwriting factor for the underwriter to look at. Other important factors include the insured's age, the health of the person, use of tobacco. So when it comes to occupational considerations, job duties, not just job titles, but looking at specifically what is the duties of the worker. And they're going to be grouped into classifications depending upon how hazardous the job is, the income that's associated with the job, and the history of claims from others with similar jobs. So generally speaking, of course, lower risk jobs like office workers are going to be placed in a less hazardous job classification. It's going to pay a lower premium. Higher risk jobs like construction workers are going to be placed in more hazardous job classifications and going to pay higher premiums. So unlike medical expense policies, individual disability income policies are subject to medical underwriting. And therefore, insurers are allowed to charge more, reject applications for individual disability income insurance based on health history. So the Affordable Care Act, which was passed into law, I guess, gosh, it's been 16 years now. 2010 is when it became effective. And he essentially said that, people are allowed to get health insurance through the marketplace. Anybody can get, pretty much anybody can get insurance through the marketplace. There's no medical underwriting. People can get individual health insurance policies for the same price as anybody else, regardless of their health history. And so there's no medical underwriting for those marketplace plans. However, remember with disability insurance, especially individual and disability insurance, there's no individual medical underwriting. And a person can be charged. There is medical underwriting. There is medical underwriting for individual disability income policies. There is medical underwriting, and a person can be charged more if they have health problems. All right. Any questions or comments there? Okay. Another underwriting factor is the income or wages of the person. So few disability income policies are going to pay 100% of an individual's lost income. Most are going to provide benefits of maybe 50 to 85% of the insured's net earned income. And typically, the higher the individual's income, the lower the percentage will be. So instead of paying a specified percentage of income, some policies will pay a flat amount, though, like $100 per day, for example. And there's two different kinds of policies, individual policies. There's valued contracts and there's stated amount contracts. So valued contract, the benefit shown in the policy is based on a certain amount of earnings, and a certain benefit is guaranteed to be paid even if the insured was not earning that much when he or she became disabled. So that's kind of like life insurance, right? So let's suppose I'm insured for a $100,000 death benefit on a life insurance policy, and I die. My wife gets $100,000. The insurance company can't argue, well, you know, John was kind of a lousy guy and he wasn't a very important person, and he really wasn't worth $100,000. We're not going to pay $100,000. So that's not the way it works for life insurance. That's not the way it works for a valued contract disability policy. So with the valued contract policy, if the benefit is, let's say, $1,000 a week, it'll pay that $1,000 a week, even if I'm not making that much at the time I become disabled. But stated amount means that there's no guaranteed amount. Unlike valued contract with stated amount, there's a stated amount, like maybe $1,000 a week, but the benefit is going to be based upon the earnings shown. The benefit is based on an earnings amount shown in the policy, but the actual amount paid is not based on that amount if the insured was not earning that much when he or she became disabled. So important distinction between valued contracts and stated amount contracts. Furthermore, most policies define the length of time that benefits will be paid. The most common benefit periods are 1 year or 2 years. Those would be for the short-term disability, or could be long-term up until age 65, for example. And of course, the longer the benefit period, the higher the monthly premium will be. So sometimes when people apply for individual disability income, the application could be rejected. And there's different outcomes, of course, when the application goes through underwriting. Number one, if the application meets the uninsured's underwriting requirements, the application will be issued, of course. If the application does not meet the insurer's underwriting requirements, the application can be rejected. Or if the application is not rejected, but the applicant is a higher than average risk, the policy can be offered for a higher premium, and this is known as being rated up, or it could be issued with an exclusion rider or limitations like we're not going to pay for this, or we're not going to pay up to that, we're going to pay a lower amount. All insurance policies have exclusions, and so here's some common exclusions. Different policies are going to have different exclusions, but disability policies typically have exclusions for war or active war, military service, intentional self-inflicted injuries or suicide attempts, normal pregnancy, travel to foreign countries, risky activities, committing or attempting to commit a felony, or being incarcerated in jail, prison, detention center. Here's some quiz questions. Number one, unlike individual medical expense policies, individual disability income policies, finish the sentence. All right, another easy one. And number 3 is the right answer, or Charlie, C. Individual in disability income policies are subject to medical underwriting. So the Affordable Care Act, which prohibits medical underwriting for the marketplace plans, for example, that exemption for underwriting does not apply to individual disability income policies. Insureds with the following underwriting factors, except which one, have a lower risk for individual disability income insurance. Okay, this is kind of a tricky one. So we're saying here there's we're looking for which have lower risk individual disability income insurance. Which ones are lower risk? So there's 3 of them here that are lower risk. The ones that is the higher risk is going to be the right answer to the question. All right, so safer occupation, of course, has lower risk. A non-tobacco user is lower risk. A younger age is lower risk. But the one with the higher income is going to be higher risk, right? Because it's kind of like the same concept as if you have a great big house and I have a little house, you know, you have more risk. You have more to lose if you have a big house and I have a little house. So same kind of concept applies here. If you have a higher income and I have a lower income, you have more to lose. You have more income to lose. So higher income is more risk. And so underwriters take that into consideration. There's more exposure. There's more risk for a higher income individual. Any comments or questions there? Which of the following is not a common exclusion? So there's 3 things here that are common exclusions. The one that's not a common exclusion is the right answer to the question. All right, lots and lots of right answers. So flying on Delta, United, American Airlines, and so forth, Northwest. Yep, that's not an exclusion. So if I become disabled flying on a passenger commercial aircraft, become disabled, that's not an exclusion. One more. For individual disability insurance underwriting, job duties, not just job titles, are grouped into classifications based on how hazardous they are, the income that is usually associated with the job, the history of claims with others with similar jobs, and generally speaking, lower risk jobs, like an office worker, are going to be placed into what? All right, of course, it's going to be A. Office workers, for example, are going to be put into a less hazardous job classification, pay lower premiums. All right, we got another perfect score. Great job. We're going to focus now on group disability insurance. So in addition to providing sick leave for employees, a lot of employers will provide disability benefits to their employees. And that's called group disability income insurance. There can be short-term disability or long-term disability, or some employers will provide both. And so if the employer pays some or all the premium, or I'm sorry, if the employer pays the entire premium, then the policy is considered to be non-contributory. Looking at it from the employee's perspective, the employee doesn't contribute to the premium, so that's called non-contributory. But if employees pay part of the premium, the policy is considered contributory because the employees are contributing to pay the premium. So it's always important to remember that whenever an employer pays for some kind of benefit, it doesn't matter if it's health insurance, it doesn't matter if it's a bonus on the paycheck, or if it's disability insurance. Anytime an employer pays for some kind of benefit that benefits the employee or the employee's dependents, it's a tax-deductible business expense for the employer. But then the trade-off is that benefits received by employees that are attributed to employer contributions are taxable to the employee.
John, we have a question here. It's from Bob. He's saying, can a person have multiple contracts, i.e. group plans, AMD plans?
Yeah, so it's possible. I guess it's, kind of like the same concept as I can have my own personal life insurance, and I can also get life insurance through my employer as well. Yeah, it's possible. There's no law or rule against it, but you want to be careful about duplication of coverage. And so, if I work for a big employer and I have pretty good disability insurance through my employer, probably wouldn't make sense for me to get my own individual policy. It'd probably be a duplication of coverage, and I can't be double indemnified, so probably wouldn't make sense for me to do that. Laura says, not true for health plans though they have to be coordinated as dual coverage. Okay. So I think short answer is yeah, possible, but probably wouldn't make a lot of sense in my opinion, just my opinion. All right, so again, there's non-contributory, there's contributory, and so benefits received by employees that are attributed to employee contributions are not taxable for employees. So example is, so if I have group disability insurance through work, I pay half the premium, my employer pays half the premium, I become disabled, the benefits I receive are going to be, half of the benefits received are going to be taxable, half are not going to be taxable. All right, so let's talk more about short-term disability. I'm going to have elimination period of maybe, there might not be any elimination period, but there could be elimination period of 30 days. And these plans have a benefit period that lasts for 3 months or up to 2 years. Over a 6-month benefit period is common. Short-term disability is going to pay a percentage of the disabled worker's wages, like maybe 60 or 70%, although some policies may have higher or lower percentage. And normally only non-occupational disabilities are covered by short-term disability because the employer's workers' compensation policy is going to pay for occupational disabilities, things that injuries or illnesses that cause disability that are related to the work itself. So again, under group insurance, If an employer provides short-term disability, it's typically going to pay for only non-occupational disabilities because occupational disabilities will be covered by work comp. So employers often also provide long-term disability, and these plans are going to have a elimination period that's going to coincide with the benefit period for the short-term disability. Right, so the short-term disability has to pay first, and when it's done paying, then the long-term disability will start. Long-term disability plans have a benefit period that can last for a certain number of years, like maybe 2 years, 5 years, or until the insured reaches a certain age, like 65, for example. Long-term disability income plans pay a percentage of the disabled worker's wages, usually 50 to 70%. But lower paid workers may receive a higher percentage than higher paid workers. And non-occupational and occupational disabilities are normally covered by long-term disability income plans. So this chart here, I think, does a nice job of highlighting the differences between individual and group disability plans. So individual policies are usually, maybe not always, going to have a higher premium per person. Group plans typically have lower premiums per person because it's kind of like, you know, get a volume discount, so to speak, on a group policy. Another reason why there's lower premiums for group plans is that there's no individual underwriting. We don't have to go through the expense of underwriting each person's eligibility. But with individual policies, there typically is extensive individual underwriting. Individual policies have more flexibility, more options to choose from. Group plans tend to have less flexibility, like maybe 1 or 2 options only to choose from for the employees. Under an individual policy, premiums paid by an insured are not tax deductible. Don't get a tax deduction for paying the premium on the disability insurance or the life insurance or home insurance or auto insurance. But with group plans, premiums paid by employers are a tax deductible business expense. And then what about the taxability of the benefits under individual policies? Benefits are not taxable, just like auto insurance, home insurance, life insurance, and health insurance, other health insurance policies. The benefits received by an individual are not taxable. But under a group plan, the benefits received by an individual, by the individual employee, is a tax deductible event. I'm sorry, not tax deductible, it's taxable. The income is taxable. As far as the premium paid by the employer, that portion of the benefit, which could be all of it, is taxable. It's taxable income. And under individual policies, individual policies usually cover both occupational and non-occupational disabilities. But under group plans, it's more typically focused for non-occupational disabilities because workers' compensation will pay the occupational disabilities. All right, any questions or comments about the key differences between individual and group plans? All right, I'm not seeing any. All right, let's do a few quiz questions. If the employer pays the entire premium of a group disability income policy, the policy is considered to be what? All right, I'm looking at all your answers. I think everybody's getting it right. It's non-contributory because looking at it from the employee's perspective, the employee is not contributing anything if the employer is paying the whole amount. Disability income plans offered by employers that usually have an elimination period of 0 to 30 days and a benefit period that lasts for 3 months or up to 2 years are considered to be what type of plans? All right, it's going to be, of course, short-term disability. Good work. Insurance premiums paid by employers for policies that benefit employees and their families are what? Another easy one. And of course, they're tax deductible business expense for the employer. Number 4, compared to an individual policy, a group disability income policy has. All right, so far so good. I don't see any incorrect answers. You're all superstars. So group policy has no individual underwriting. Awesome. Next, let's talk about more about from a business perspective, some different flavors of disability insurance. So just like with life insurance, there can be key person life insurance or key person, key employee, key person life insurance. There can also be key employee, key person disability insurance. So with key employee disability income insurance, the employee is the insured under the policy. The business, though, owns the policy, pays the premium, and is the beneficiary of the policy. The business has to get written consent of the employee before purchasing this type of policy, just like with life insurance, key person life insurance. And since the policy is for the benefit of the business does not receive a tax deduction for the premiums paid. And benefits received, though, by the business are not taxable income. Another flavor of business disability insurance is called business overhead expense insurance. So there's a small business owner, and if that small business owner becomes disabled and unable to work, this type of policy can pay for business expenses incurred during the disability. You can kind of think of it as a policy that helps keep the lights on and help the business stay in business while the business owner is disabled. So some examples of expenses that are covered by a BOE, business overhead expense policy, include employee salaries, office rent and utilities, office expenses, accounting, legal, and other professional fees. So here's some more important things to remember about business overhead expense. It does not pay, this type of plan policy does not pay for the disabled owner's salary. There's going to be elimination period, maybe 15 to 30 days that the business owner has to be disabled before it'll pay. The benefit period is usually going to be 1 or 2 years. And premiums paid by the business are a tax deductible business expense. Benefits received by the business are considered taxable income. These policies pay the actual amount of covered expenses up to the monthly policy benefit limit. Next is disability buy-sell. And there's a similar thing that under life insurance buy-sell. So we first have to understand what we mean by a buy-sell agreement. So buy-sell agreement is not insurance. A buy-sell agreement is a legal contract between owners of a business specifying what will happen if one of the owners dies and becomes disabled and unable to work. So let's suppose that Nancy and I are business owners. Nancy, what kind of business do we have?
Oh,
Donut
we
shop? Go ahead.
Me? What did you just say?
Donut shop or
Yes, that would be fine, or elegant clothing.
elegant,
Anything you want.
elegant. Okay, elegant clothing. So Nancy and I are business partners, and so I rely on Nancy. Nancy relies on me, and maybe I'm, I don't know, really good with something. I don't know what I'm good at, but I'm good with the paperwork, and Nancy's good with everything else about the business. So we complement each other, and we should have a buy-sell agreement in place. So if something happens to me, I die or I become disabled, what's going to happen to my half the business, right? And so a buy-sell agreement spells that out. It's not insurance. It's an agreement as to what's going to happen if, like say, I become disabled, I'm no longer ever going to be able to work again. What's going to happen to my half the business? Well, buy-sell agreement might say that Nancy has the opportunity to buy me out if I die or if I become disabled. So this can be true for, life insurance. We can get life insurance for this. We can also get disability insurance for this. So the question then is, let's say our business is worth $4 million. I own $2 million of business. Nancy owns $2 million of the business. I become disabled, can't work. Nancy's going to be able to buy my half out. And maybe Nancy's loaded and she's got an extra $2 million laying around to buy me out if I become disabled. But maybe it'd be kind of nice to have some type of insurance in place to help Nancy be able to buy me out if I become disabled or die. So key aspects of buy-sell insurance is we can say that it's used to help fund the buy-sell agreement. Insurance is normally purchased for each owner of the business. Each owner is an insured. Normally the business is the policy owner, pays a premium, and is the beneficiary of the policy. Since the policy is for the benefit of the business does not receive a tax deduction for the premiums paid. Benefits received by the business are not taxable income. These policies typically have an elimination period of 1 to 2 years. That means that the insured must be disabled for that long before the benefits are paid. Benefits can be paid in one lump sum or in monthly installments. If paid monthly, the benefit period is typically only a few years. All right, let's do a couple questions. Which is true about business overhead expense insurance? Which one's true? A, B, C, or D? Kind of a tricky one, but most of you correctly identified that C as in Charlie is the right answer. Premiums paid are tax deductible business expense because it's for the benefit of the business. And benefits received by the business are considered taxable income, or I'm sorry, the benefits received are, the premiums paid are helping to keep the lights on. It's not intended to pay for the owner's salary. So Charlie is the right answer, C. Premiums paid are tax deductible for the business, but then the benefits received are taxable income. Which is not true about business overhead expense insurance? Yep, it's going to be C. That's the one that's not true, which is the right answer to the question. It doesn't pay for the owner's salary. It'll keep the lights on. It'll pay the employees, pay the office expenses like the rent, utilities, and things like that. All right. So we had a question earlier about Social Security. So I want to touch upon that a little bit. So we talked about let's see, the thing about 2 years came up. Waiting period. So it's 5-month elimination period. Shoot, where was that? Oh, maybe it's all right, 12 months, I guess. So the individual must not be able to engage in any gainful activity because of medically determinable physical impairment that it expected to result in death or expected to last for a continuous period of at least 12 months. So that's the Social Security Social Security Administration definition of disability. So it has to last at least expect to last at least 12 months. So there's a 5-month waiting period, a 5-month elimination period, but then it has to expect to last for the continuous period of at least 12 months. Yeah, 2 years has to do with access to Medicare. Thank you for clarifying that. All right, I wanted to before we wrap things up, I want to just review one thing that you never know what might be one of the polling questions. So I want to share this with you before you're expected to answer the question. Let's see. All right, here we go. So under group disability insurance, A, there's extensive individual underwriting. B, the benefits received by employees are not taxable if the premium was paid by the employer. Or C, premiums paid by the employers that benefit employees are tax deductible for the employer. So which one is correct, A, B, or C? All right, yep, the best answer is going to be C. Premiums paid by employers that benefit employees are tax deductible for the employer. So A is wrong because under group disability insurance, there's typically no individual underwriting. Everybody that applies for it, everybody who's part of the group is going to get it. And B is wrong because it says benefits received by employers are not taxable if the premium was paid by the employer. The opposite is true. If somebody has group disability insurance and is getting a benefit, any of the benefit that's due, that's attributable to the employer's premium is taxable. So C is the answer there. All right, that's going to wrap up things for me today. I'll stay on the line in case anybody's got any questions about anything. I'll stay on for a few minutes, but otherwise I'll turn it back over to Doug or Nancy or somebody. Thanks, everybody. Appreciate you being with me today. And remember, you can give us a call at any time if you have any questions about your C credits or your insurance license exam prep for if you're adding a line or having somebody getting their insurance license. Take care, everybody.
Thank you, Kirsten. Thank you, Nancy. So we will be sending that out to you. We need to document for the state, or John needs to document for the state, that you guys and he have followed the procedures in order to grant you CE credits. So please take care of that. I'm going to turn off the recording and thank you for coming, and we'll see you next time. We'll stick around too. Thanks.